Well, good afternoon, investors. Welcome to our August 27th edition of Bull Sessions. My name is Mark Robertson. I am joined here by the magical mathematician, magical mathematician from mid-Michigan, Ken Kavula. Good afternoon, sir.
Good afternoon. We can retire all the M's here. We don't need all that. So,
No, we just antagonized Kevin into giving you a few more M's.
all right.
All right, we're also joined here in the back room by our special guest, Kim Butcher, currently of Evansville, Indiana, but probably on her way back to the heat of Florida. Good afternoon, Kim.
Hi, good afternoon, everyone. Stay in the air conditioning.
And speaking of heat, Houston's own Matt Spielman is hopefully with a functioning air conditioner, but he is joining us also. Good afternoon, Matt.
Well, it's only 90 degrees. It's a cool front in
Ah, there you
Houston.
go. Texas winter, as you said earlier.
Texas winter.
All right, and I've also asked Ty Hughes to join us. Ty gave that wonderful presentation on the government retirement plan last summer, and he reminded me of Hendershot investments. So we're going to do some Hendershotting here in a few minutes. Good afternoon, Ty.
Hey, good afternoon, everybody. And it's 89 degrees here in Arlington, Virginia, if anybody's interested.
All right, we're going to try to keep it short and sweet here today. We do have a roundtable tonight. We'll talk a little bit about that, but we're going to continue our best small company prospecting a little bit, talk about that Hendershot investments, give a quick wrap up to the changes we made in the utility bill auto pay demonstration portfolio last month, and then we'll talk just briefly about this Berkshire Hathaway / Warren Buffett crush on Occidental Petroleum. They now own, I'm pretty sure it's 34% of Occidental, and just want to take a quick look at that and see if we can demystify what in the world are they thinking. So with that, anything else you want to cover here, Ken?
No, I think that'll be plenty for 1 hour, Mark. So let's get our
All right, get
teeth
underway.
into the whole thing and get underway here.
Here's
I'm very amazed, Mark. Before you start, I'm really amazed at this price chart here. I don't know what you've done to talk it up from that August low, but you've really talked it up here so that it's actually worth something now. $12.40 some odd cents. Okay. So now can it stay up there? I don't know. We got September coming up now.
That is just a broadening awareness of the Portillo product and consumption. And you can see by the chart that Kim provided there on the lower left that they are expanding very strategically into areas where they expect to find love and obsession ultimately. So good stuff. Yeah. This is the weekly reminder that Portillo's is not a sponsor of the session, but they should be. All right, we'll keep moving on. Here is our reminder, especially if you're new here. No investment recommendation is intended. If you're new here, you're most welcome. Good to see you and hope you enjoy our banter for the next hour or so. Everything that we do here is an educational demonstration, just like it says. We're big on taking and illustrating some stuff that we have discovered, the methods, techniques, and philosophies of the modern investment club movement. That being the discover of opportunities, the analysis of said opportunities, and the construction and maintenance of portfolios based on some good stuff. You're going to see that with Ty Hughes and the portfolio he talks about there. They really think a lot like us. So you're going to hear opinions expressed by all of us. Please do your own homework before making any investment decision. If we own something, we'll try to remember to disclose that. And we know that you are smart enough to make your own decisions about things that are helpful to you. We do have a roundtable tonight, so we'll try to keep this brief. If you're not familiar with the roundtable, just really quickly, the elevator speech, friends gathering on a monthly basis for the last 14 years. On the last, am I going to get this right? Last Tuesday of every month, for the most part, 8 o'clock Eastern time now, we basically bring an idea and share it and share the analysis of it. And we will be going over 4 or 5 stocks tonight. Again, that's 8 o'clock Eastern time. If you would like to be added to a reminder list, just send us or if you want copies of these slides, or if you have questions that require answers, or if you have suggestions for future topics, are to email addresses are there at the bottom of the page. Anything else, Ken?
No, that covers it pretty well. We have a real full agenda for this evening, so we're going to start right on time and try to keep the preliminaries to a minimum. And we have 5 great stocks to discuss this evening with 5 pretty decent presenters coming up. So it'd be a nice session to come to and to learn a little bit from, I think.
Yep, and we are chugging away at about 17.5% annualized rate of return. So that's since 2010. All right, here's our groundhog challenge. We do have that runaway groundhog, and he might get his own special page at some point because he's clearly turned the page on most of us. There's some wonderful results being turned in by a number of people. But again, I find myself losing interest as my eyes drift down the page and I do not spot my name. I do spot Ken's at number 10. Kim's at number 23.
Yeah, Kim is on there too. Yeah.
I'm feeling lonely and left out.
I'm happy
I
to
see.
have consistency to be in the top 10 year after year. Because, you know, the market, and this is a 1-year time frame, and each month it could be totally different of who's number 1 through 10. But consistency, I like the idea to be consistent.
Mm-hmm.
I see that Herb Lemkohl has broken into the top 40. He's one of our directors in Mid-Michigan, and so is Mary Reynolds, who's broken into the top 40. So congratulations to Herb and Mary both down there at 37 and 39.
Yep, and we've continued to have a solid representation of investment clubs on the list. So good, clean fun. Again, over a third of the participants beating the market since Groundhog Day. We're over the halfway point now. The average groundhog checking in at about 11%. And I continue to be, hold on for a second. In fact, I'm going to go to the next slide, Ken, and you can take this one away. I need to mute for just a minute, just a second.
Okay, well, we're looking at the performance of the market, if you will. Light green bar is representing the average return for this particular quarter. We're 2/3 of the way almost through this quarter, so that bar is still variable length. At the end of September, that bar will turn dark green, and we're hoping that it'll be somewhere up near the blue line. The blue line is the line of reasonable expectations, and that's representing about a 10% growth rate, which has been the average for the stock market over long periods of time. You can see right now that the MyPar number, that's the average potential return for the stocks in the Manifest Investing database, is just under 9% at 8.8. And you can compare that to the average return for the Value Line database, and it's sitting at 9.7. They usually track fairly closely to each other within a percent like they are right now. That PROVE number, PROVE is the potential return on value for the enterprise, and that PROVE number is tracking for the average stock at just about 9.1. When the PROVE number and the MyPar number track close to each other, that gives us a lot of satisfaction and a lot of validation for our analysis that we're doing, because we're coming at the same value, the potential, and we're coming at it in 2 completely different ways. MyPar depends on PE. PROVE depends on the balance sheet more than anything else. So
Right.
all in all, we're trying to these 2 values, and they track together. That's a wonderful thing. I don't think we've ever seen the overall PROVE number deviate very much from the overall MyPar number since we've been using PROVE in a regular basis. Have we, Mark?
It can drift a little bit, and then on individual stocks, it can obviously drift quite a bit, depending on
Absolutely.
variations in PE
Yeah.
ratio is
And
the
that
most
point,
common culprit.
that points us then to rethinking sometimes the PE values You can't really rethink the capital structure, but you can rethink the PE values. And when the proof drips too much away from my par, it leads us to rethink PEs sometimes in both directions, sometimes making them a little bit more robust and sometimes making them a little bit more conservative in
Yep.
our analysis.
All right, good stuff. So again, we're kind of back at normal conditions with that green bar tucking in behind that line. All right, just thought we'd take a quick look at one of the more interesting things discussed in this book by Jim Cramer a few years ago, and it just shows how weird COVID actually was. You can see that the tremendous drop in employment that came with COVID here in the early part of this decade, and then the fairly rapid recovery, and then of course what's been going on over the last several months and years. So it's just kind of fun to look at that, and it would suggest that 818,000 is a pretty material thing. I don't know how they restate this, or if it's already restated. I don't know that, but it's a number of some consequence. But it also is a pretty solid reminder of, and this was the topic or the theme under which Jim Cramer presented it. These were real recessions. Recessions are basically times when, one, people become unemployed, and two, our stock studies and stock selection guides get wrecked. And that's what you need to know about those gray areas on the chart. Anything jump off the page at you, sir?
Well, no, but I listened to a group of economists discuss this 818,000 number, Mark, and they attribute a lot of it to the fact that the Labor Department did a terrible job in their standardization. They call it, making adjustments, seasonal adjustments.
Mm-hmm.
And the Labor Department, turns out they did a terrible job in making seasonal adjustments coming out of the pandemic. They made assumptions that in some cases were way too optimistic, and they made assumptions that in some cases were way too pessimistic. And the difference is that you can't really go into the United States and count every head that's working. You have to base it on some trends and some assumptions. And the Labor Department just did a really terrible job in doing some of these seasonal adjustments, and therefore ended up 818,000 jobs fewer than they had anticipated a year and a half, 2 years prior.
Yeah, it's interesting. I'm sugarcoating. All right. Let's go ahead and talk for just a second. I don't want to belabor this too much, but it is a subject that has come up here in a couple of different venues from time to time. Berkshire Hathaway and Warren Buffett have been regularly investing, accumulating shares of Occidental Petroleum to the point where they currently own 34% of the company. And one of Kim's favorites, Monish Pabrai, actually has commented on this, and it's kind of fascinating as you dig into it a little bit deeper. Kim, are any thoughts on what is Buffett really interested in when it comes to Monish? I'm kind of catching you cold here, but I know you've thought about this.
I mean, I have Oxy in my own portfolio.
Okay.
And I started buying it when it was a kind of Hugh influence, when it was really, really low. And I recognize as he was buying it, it was under 60, and then under 62, he was adding more shares. And I felt as long as management was cleaning up the balance sheet and reducing debt, what was going to result with the capital allocation, because capital allocation is paramount, they were going to be having a lot more cash coming in, so that then they would be able to raise the dividend, and Buffett wants dividends. And that way it lets him invest in other companies. And no, he doesn't want to manage the company himself. He likes how the current CEO is managing Oxy. So for me, it was like, aha, he wants just more shares, so he gets more divvies. the more divvies he gets, the more he can invest in other companies, which is kind of how he's done with a lot of it. He just does his capital allocation and make sure that his management, he agrees with what they're doing. And then he just, and when they've needed money, they get it from Buffett. And what happens is then he gets a little premium on his preferred shares, which all of us would love. So it's all capital allocation to me. And then I kept reading about this, and it's like, cash is king, and they're getting more and more cash. That's why he has, 200 and some odd billion in cash sitting on the balance sheet for whenever the market may take an adjustment, or he finds a great stock that he can add to the portfolio.
Yeah, and I think the key statement's right here. I mean, he looks at Oxy as U.S. Treasuries on steroids. This is clearly a turnaround situation. We'll take a little bit closer look in a minute, but these are two very different companies. I mean, ExxonMobil continues to be in as part of their operation, exploration and production. So they get two completely different financial health pictures. But that doesn't mean that you can't make a decent buck on them. And here's the two side by side. They have very similar price patterns going back over many years. And the thing that I kind of want to point out, here's where the premium is. I mean, ExxonMobil has an annualized total return in low single digits. Occidental has this, assuming that they pull off the turnaround. And the one thing that kind of jumps off the page at me, and guys jump in if you want to here, I mean, the cash flow here, cash flow divided by sales here is a pretty high number, approximately 40% of sales. And you'll notice that their capital spending really has basically stabilized. They had much higher capital spending as a percent of sales back here. And just like it says in this preceding page, they have stopped doing quite as much CapEx spending, and they're basically just harvesting off the flow of the oil, kind of a Jed Clampett situation. Whereas down here, you have a much lower cash flow per share, as a percentage of sales, and the capital spending has remained relatively constant, again, as a percentage of sales. So you do have a situation where these guys are not, because of the type of company that they are, they're just not getting as deeply into the exploration and production. They still have some. It's just not as predominant as it was in the past. So Monisha's words do make sense. They might be a little bit different, but you can see the obvious return on the projected return forecast is strong for Occidental Petroleum if they continue to successfully go down this path. Any other comments, Matt or Kim?
Yeah, can you go to the previous slide real quick?
Sure.
Everyone look at the long-term debt load. Exxon's got 60% debt. Oxy's got 28. So if interest rates go up, it's going to be, for me, it's harder for Exxon to pay out their divvies. And then you also have the variable of what happens if the price of a barrel of oil, if it gets up to 80, 90, 100 bucks a share, woo-woo, we're going to be thrilled. But if it gets back down to 60 or $50 a barrel of oil, it's hard to make money and then still pay your debt. So, I love those companies who have very little debt, and Oxy's has got a better amount of debt to deal with of whatever is going on in the market. Whether the price of oil goes down, they're going to be okay because they won't have as much debt to pay off compared to Exxon, because no matter what, you got to pay off your debt, and Exxon's going to be putting more money towards debt.
Yeah, and they do have a fair pile of cash over here though too. So it's a strong company. There's nothing wrong with Exxon financially, but Kim's right. It would place a strain. So anyway, just thought we'd take a shot at showing where that statement comes from and what the background is behind it. So we'll just kind of leave it at that for now. All right, here was a news flash that came just as around lunchtime today. Costco's at an all-time high today. And this is one of those coulda, woulda, shoulda files for me. I was transferring some stuff from one account to another, and I only did half the job about a year and a half ago. And that was at $300. So I sold it in one account, meant to buy it in the other, and messed up.
Mark, here's a really good value lesson on what Mr. Nicholson said about being very careful about selling companies whose sales growth rate is in double digits. I'm in an investment club that has a significant stake in Costco, and that club's SSG has been flashing a sell signal for Costco for the last 4 or 5 months.
Yeah, yeah.
And we've resisted that sell signal basically through 3 or 4 of us continuing to preach that Mr. Nicholson knew what he was talking about, and we should be patient with some of these stocks that have sales that are still growing in double digits, and Costco's one of them.
Mhm.
So this kind of news is music to my ears. It's just going to push that par into another lower value for the moment until the analysts all reanalyze what's going on and take this quarter into account and everything else and come out with some new numbers. Same thing's going to be true on all the data sources. Remember that the data sources, whether it be Value Line or Morningstar or Manifest or anybody, they're not by the minute, they're by the well, we're lucky if they're by the week a lot of times. And you gotta keep that idea in the back of your head that when Nicholson said be very careful in selling companies growing in double-digit numbers, he meant it. And I think it's a value lesson for all of us to internalize and to really think about a little bit.
Absolutely.
Not necessarily to follow 100%, but to think about.
Ken, I did a little field research yesterday. Wendy's been out of town, and it was actually Sunday. And I figured, lunchtime, Sunday, I can go to Costco, maybe have the store pretty much to myself.
Rookie
And
mistake.
so I go, and there wasn't. We live by one of their big stores with a huge parking lot. Ken knows it well. There was not a parking spot. There was not a
rookie mistake, Mark.
there wasn't a cart in the entry area. So I get to the cash register, and that took a while. But I said to her, I figured my strategy was good, coming at lunch on a Sunday. And she goes, this is actually one of the 2 busiest days of the year. And I said, why is that?
You got it.
She says, the kids go back to school tomorrow. Parentheses, you idiot. She didn't say that, but she thought. She thought it. So
well, whether it's the second busiest day, Mark, Sunday afternoons around lunchtime all the way to maybe 3 o'clock are just absolutely terrible times to go to Costco. Come on, you have free time on Tuesdays and Wednesdays. Go on Wednesday at 2:30 in the afternoon.
Right.
Okay.
Enough beating up on myself. It wasn't Costco. Costco is alive and well.
Yeah, Mark, just to let you know, don't forget Sundays, everybody gets off church and then they go do their grocery shopping. So I don't go on the weekends.
Yeah.
But I did ask the Costco worker one time, I said, okay, this is packed in here. This is not, what is the best day that is the absolute slowest here? He said Tuesdays and Thursdays.
Okay. Note to self. Good stuff. All right, a couple things here. Again, our top 10 companies continue to perform pretty well. Again, this is a very long-term thing, so it's not going to change very much. The roundtable is back above a relative return of 5%, so we'll celebrate that tonight a little bit. The Dow Jones Industrials hit an all-time high yesterday, and they're still pretty far down on this chart. And then I wanted to put these two up side by side. The Russell 2000 growth, which is VTWG versus the Russell 2000, and that's all of the small caps. And I guess I was a little bit stunned that there wasn't a bigger difference between the two. And in fact, the Russell 2000 came in with a higher quality rating. So I need to scratch my head over that a little bit. But small caps are small caps, apparently. All right, so let's go ahead and talk Hendershot Investments. This is a firm that I became familiar with back right around 1994. As I got more involved in investing, and then we actually covered them in Better Investing magazine on a couple of occasions. But I've invited Ty Hughes from Arlington, Virginia, to give us his thoughts on the company. So, Ty, why don't you take us away and describe a little bit about this?
Sure, Mark. Well, it's interesting. Ingrid Hendershot established this investment company back almost 29 years ago, and she's been a friend of the DC chapter. She's presented several times at our annual meetings. And so let me just say at the outset, this is not a commercial for her
No, not at all.
services, but her investment philosophy is so sound and so similar to ours that I thought it might be instructive to just to run through it. I've taken from both her from her website and her investment advisor registration, the ADV2A form. I've kind of taken the key points, and Mark's going to show you in a little bit here her list of 40 or so stocks that she tracks, and you'll see how similar they are to the stocks that would come up on our list if we were doing an analysis and trying to select stocks. So they've had, so they've been in business for about 29 years, and they had, as of the end of last year, they had about $900 million of assets under management. And she's just a genuinely nice person. Her approach, though, to investing is very sound, very similar to Better Investing Community. The essence of it can really be summarized in one sentence. She looks for high quality, well-managed companies at reasonable valuations and holds them for the long term. Let me just repeat that. High quality, well-managed companies at reasonable valuations and hold them for the long term. We've all heard that mantra before. It's great, sound advice. She does note that occasionally she'll sell a stock in less than a year when the circumstances dictate. So how does she find them? She pretty much the same way we all do. She looks at the annual reports, the SEC filings, company press releases, financial newspapers, magazines, and research materials prepared by others. As we all know in this internet age, accessing this information is relatively easy and inexpensive. It's just, in my opinion, the challenge is sorting through all of it because there's so much of it out there now.
Mm-hmm.
And then also, just like our investment clubs, Hendershot will listen to the quarterly earnings conference calls with management, trying to get an insight into the management and keep abreast of what's going on with the company. So how does Hendershot assess a company? Ingrid Hendershot looks at three things: fundamentals, just like we do, whether the company has a competitive advantage in the marketplace, and the quality of the management. Those are the three big factors. And let me just amplify a little bit on them. The fundamental attributes that they look at Hendershot is return on equity. Shareholders look for high return on shareholders' equity. They look for steady sales and earnings growth. What do we call that? We call it up, straight, and parallel. They look at strong and growing cash flows, manageable debt, and balance sheet. When you sum that up, these are exactly the same things that we look at in the stock selection guide. Maybe the balance sheet's not there, but everything else is.
Mm-hmm.
The second thing they look at, and this is more subjective maybe and requires a little more research and some thought, but does the company have a competitive advantage? You know, some people call that a moat, but what they're looking for are differentiated products. You know, are there patents protecting their products? Do they have some unique advertising advantage like Coca-Cola? Is there something about their services or their goods that gives them protection in the marketplace? She also looks for economies of scale. Does the company have that advantage in production or marketing or maintenance of the products or services? And this is something I hadn't thought about. Absolute cost advantages. Can the company obtain, for example, raw materials at lower costs than the competitors? And then another advantage, another type of moat is what is the capital requirements to compete with that company? Does it require a big investment to get in the market to compete? So all of those things together, they look for companies with a competitive advantage, and there's no easy way to do that. I don't think. You've got to give that some research, market research, and some thought to decide if a company has a competitive advantage. The last thing they look at, and I know I've heard this many times on the bull sessions here, is the quality of management. Does management intelligently allocate cash flows that the business generates? Are they being smart on acquisitions? Are they being smart about purchasing back shares? Are they being smart about dividends? And again, it's a subjective judgment, but those three factors, fundamentals, competitive advantage, and management, are what Hendershot looks at. And they quote, she quotes Philip Fisher on their website, if the job has been done correctly when a stock is purchased, the time to sell is almost never.
Yeah.
So that's how they assess the companies. And then the next part of it is how they value it. And here's probably where Hendershot differs a little bit from us, but not that much. Once they found a high quality company, they try to make a judgment, all right, is it over or undervalued? And they use a discounted cash flow methodology, and they look out, try to project the price in 12 to 18 months. You know, in our stock selection guides, we try to project out revenue and earnings, and then we kind of take a 5-year look. But some of you may remember Ralph Seeger from a long time ago. He was a big advocate of looking at the analyst projections for 1 to 2 years as sort of a judge, as a guide for projecting out the revenues. And that's, I think, what Hendershot does in her analysis here.
Yeah, and
but it's, go ahead.
I was going to say, I think we've seen Value Line also go to that type of shorter time frame, so it's a two-pronged approach.
That's right. That's right. And one of the things I personally like, one of the things I like best about the new stock selection guides now on Better Investing is you can click on that and you can, it'll overlay Morningstar or some other services projections for the next 2 years. So that's a great way to measure, you know, whatever growth you've projected. You can bounce that. You can see graphically how that fits into the analyst.
All right, let's go ahead and unwrap the package here, because I mean, the next slide just slams this home like a home run, Ty. Go ahead and describe this list.
Yeah, so this is this is the list of stocks that they follow. I will mention on their website, HendersonInvesting.com, you can download all of the prior editions of her newsletter, and she maintains a list of about 40 stocks. What's pretty remarkable here on the sheet, though, is the quality of these. Using Manifest Investing's quality is very high. On their buy list, I don't know if you have the buy list there also, Mark.
Yeah, we can go right to that, because that really shows. Go ahead.
Yeah, so this is these are the stocks that are on the. There's 40 stocks that they follow, about 40, if you plus or minus a few each quarter. But if you look here on the top 5 stocks or top 6 stocks, I mean, those are familiar to us. I think we've talked about most of these at one point recently, either on the bull sessions or in the evening presentations, a monthly. The other thing I mentioned that she, you know, when does Henderson sell a company? Again, this is very familiar to us. If the business fundamentals deteriorate, they'll sell a stock. One thing they do that's maybe a little bit different, they will, when a stock becomes fully valued, they may trim their position a little bit and reinvest the money in another stock. And then because they manage portfolios, they may also, if a stock is in a loss position, they might sell it if there's another stock that was, you know, they exchange it for a better stock and take a tax loss. But by and large, they're long-term holders. Well, so if you're interested, the newsletter, I think a subscription costs $50. I paid that a long time ago, and I've never been asked to pay another subscription fee. But all but the most current edition is on her website, and each month they've got a couple of companies that are highlighted, and very good analysis. And because of the nature of the companies, stocks that they've highlighted in the last year or so are still very relevant to today.
Well, I'll tell you, when a couple of the people here saw these portfolios, here's the 40, and then here's the current buy list, Ken basically accused them of copying his personal portfolio. So that tells you all.
I don't know quite this many, Mark, but almost everything that I do own is on this, not on this buy list, but it's on that list of preferred stocks. So I agree with Ty that obviously we are in the same choir singing virtually the same song to each other.
Yeah, I mean, most of these companies, 80 or 90% of them have been in the round table or one of the portfolios over the last several years. So we clearly are thinking much the same way, at least for the up straight and parallel core portion. One of the things that I would like to see, and I may actually dig, Ty, maybe you can help me with this one, is the situation at Fleet Core has been very confusing, and with the name change and whatever they're doing management wise, it's been kind of weird. It would be kind of interesting to go back and look and see what she had to say about Corpay over the
Hmm.
last several months,
I'll take a look for that. Yes, absolutely.
because that has just boggled my imagination. And then of course Roche is my longest standing roundtable selection, I think, over 10
You
years.
know, Corpay has some interesting sub-business lines. They work for FEMA. Whenever there's a hurricane and people are dislocated, Corpay has the contract to provide temporary housing for the displaced people. They don't talk much about it, but it's an interesting little
Interesting.
subline.
Interesting. All right. So again,
Mark, while you have this list up here, I'd like you to put a yellow arrow by FactSet. My investment club, the Wolves, met last night, and we had quite a discussion about FactSet. We have never seen two of our very trusted sources differ as much as CFRA differs from Value Line as far as the evaluation of the future for this company. Value Line is about as negative as I have ever seen it on any company about FactSet. And CFRA is about as positive as it can possibly be about this company. If you're looking at FactSet, I would urge you to spread the net wide and read everything you can, because a disagreement between two of the sources that I use the very most is very, very rare when it's this stark, when it's this 180-degree kind of differences between the two of them.
Especially on an established company. I can see the disagreements on the early
Absolutely.
stage stuff, but this is an extremely established company.
Yeah. So I just, I would, if you're looking at FactSet, read everything you can read. And again, the Value Line report is about as negative as I've ever read a Value Line report. And they have pretty good reasons. At least they sound plausible,
Well, they talked me out of EPAM when the Ukraine thing happened, and they were very wrong about that one. So there we go. All right. Thank you, Ty. It's a
You're welcome.
interesting gem lurking out there. So we continue to thank you and your colleagues out there for bringing us cool stuff. Ken Williams is the one who brought us Joseph Carlson a few months ago.
Mark, we're getting some comments from the audience about whether or not FactSet and Value Line are competitors to each other. And I don't really think they are. Value Line is aimed at individual investors, and it is used by the analyst community, but not in the same way that FactSet would be used. FactSet's a complete database that can be mined for all kinds of information, and a better competitor of FactSet might be Y-Charts or something along those lines.
Yeah, institutional research for sure.
Yeah.
All right. Just a little bit of closure on what we decided to do last month. I shifted gears, and the intent was to sell 150 shares of Essential Utilities and take the tax loss and use that to offset. This is budgetary stuff for next April, but basically reduce our tax burden by approximately $100, and then to take the $6,000 from Essential Utilities and put it into two non-utility but high-yielding investments. And we chose Pfizer and Dorchester, and the audience was full of suggestions about BlackRock and others that were on that high-yield list. All that works. We're just demonstrating here that you can basically replace that, capture the tax benefit down below, and still generate a really nice dividend stream. And again, the important thing here is to keep this last column on the right black, just like a checkbook. You want the number to stay positive and continue to automatically pay that utility payment going forward. So that's what was decided. And again, it's just kind of fun to watch how those two will perform. I think Dorchester will be more erratic than obviously a Pfizer, but by the same token, and I'm going to cite the Warren Buffett Occidental clause here. Dorchester probably has a bit of a premium potential for being a turbocharged yielding investment. So we'll see. We'll see how that works out.
Now, Dorchester is a master limited partnership, right, Mark?
That's true.
Okay, so we will promise to kind of keep an eye when it throws off income to the shareholder that we're going to be in this simulation. We'll keep an eye on it to make sure that it's traditional income, it's traditional dividend income, and if it starts to throw off anything that's a strange kind of of income, we'll alert you to that fact.
Okay. All right. Am I going to have to bring in the conference room crackerjack team that does the groundhog calculations every year? Or?
We might need somebody that's a CPA, right?
Oh, great. Well, Sean's in accounting now, so maybe we can draft him to take care of that one for us, or Diane. Diane Grace is a professional accountant. All right, moving on.
Right.
All right, just a quick moment with the smaller companies. And this is fun. I mean, every time I see these slides, I think of Ken and his infatuation with CNBC. But Tom Lee is on CNBC quite a bit, so you see this guy quite often, Ken.
I do, and I listen to what he has to say. He's proved to be right more often than he's proved to be wrong in the last 6 or 8 or 10 months that I've been watching for him. And I think he talks a lot of common sense. Maybe it's just that he's reinforcing some of my own biases, but I like what he has to say, and I like the fact that he's making some of the journalists on CNBC. I'm not going to put quotes around the word journalists, but I'll say it in a way that it has quotes. Okay.
I was doing it in my
head. He's making some of them a little bit uncomfortable with talking ideas that aren't necessarily the major ideas that all the rest of the herd on Wall Street is talking about right now.
Yeah, and he's quite bullish on the smaller companies through the end of next year. Goes perfectly well with our theme. Again, our open invitation for all of you to join us, suggest companies, and let's try to find a really good list of companies. I came across this on the internet, somebody playing around with AI stuff, and he's moving along pretty rapidly, it would appear.
I want to do an advertisement, Mark. I'm not a youngster anymore, and I've always been committed to learning new things as they come out. I've been an early adapter of a lot of technology, and I feel that I'm as good or better on a computer or a phone than my grandkids are. So I'd like to urge those of you that are in your retirement phase of your life to play around a little bit with some of these AI engines that are beginning to be part of the normal things that we can use. These 3 images I put together using Copilot, and that's part of the AI engine that's attached to Microsoft Bing. That's Microsoft's search engine. And you don't get to do these for free, but they do give you a space where you can play around with a few of these images and see how fast they can be generated and how easy it is to get something that you're just dreaming of in your head. Basically, what I told Copilot was, draw me a red rabbit in a suit of armor. Draw me a cartoon of a red rabbit in a suit of armor. And within 30 seconds, I had the image on the left up there. And then I said, okay, give him a sword and a shield. I didn't have to type anything more than that. Give him a sword and a shield. And within 20 seconds, I got the image in the middle. And then I said, well, what about if he were reading a stock chart? And I got him reading a book, but I did get the stock chart up on the wall behind him up there. So that was kind of neat. I think you need to play around with this stuff, and Microsoft is going to charge you a little bit to do thousands of images, but I think they're going to let you have the first 15 or 20 images for free.
Yeah.
And if you think you have something you can use them for, it's not going to be a huge amount of money on a monthly basis that they're going to charge you to be able to play in that sandbox.
Yeah.
So I'm just saying, when you're retired, you don't learn as much as sometimes you learned on the job, and you got to keep that mind working, or it's going to go stale on you. So play around with these AI things. They're a lot of fun, if nothing else, and you can surprise your grandkids by being the first in the family to come up with an image rather than the last. Okay.
Very impressive. You're promising student, Ken. All right. Here's just a quick reminder that, one of the reasons that Tom Lee talks about a little bit, and Ken and I both believe, is that it now appears that there will be a rate cut. And this just shows the behavior of smaller companies, small caps, following a rate cut 3, 6, and 12 months out. So again, that would be at least a bit of a nudge from where I sit to pursue some of these. Here's the long-term performance going all the way back. I typically don't like to go back farther than 1940, but this goes back to 26. It's from Ibbotson, and you can see, I mean, relatively small percentage amounts, but notice the difference between these two numbers. This is the 10% on regular stocks, just the average U.S. stock, including some of the big ones, versus this one. Look at the difference in those two numbers. That's a few percentage points making that difference.
Mark, can I add another statistic to this? Because it's boiled into the numbers already, but in the 70s and 80s, the Russell 2000 had less than 20% of the companies that were not profitable. And in today's markets, in the new century, that number has increased to over 40% of the companies that are not profitable. And even with 40% of the Russell 2000 being non-profitable, it still looks like they're at least matching some of their counterparts, if not beating their counterparts. So it's something that you have to keep an eye on. You have to look for small stocks in the whole scheme of things if you intend to beat the market.
And one of the things with our Red Rabbits and this whole campaign is we believe that you can find these smaller, faster growing companies and demand just as much quality in terms of consistency and predictability and everything else. You don't have to settle for roller coasters. All right.
And you don't have to spend as much time trying to look at stocks with no following either, because if you really insist on higher quality small stocks that behave like some of your great mid caps or mid-sized stocks and large stocks, if you insist on those high quality small ones, most of the time you'll be able to find readily available information about those stocks. People get into real trouble with small stocks when they pick a stock that has no earnings or virtually no history and then complain that they can't find any analyst coverage or any analyst opinions about the stock. Well, that's to be expected. And if it's to be expected, avoid that problem by looking for higher quality small stocks.
And here's a current example of that. What I did here is just real quickly sat down with the database and said, show me a list of companies with a minimum growth rate of 10%. So we want 10% growth. I want them to be less than 3 billion in sales. So that's what these are. High quality, just as Ken was just saying, and with decent return forecasts. So we're basically ranking these by the manifest ranking. So this would be the 20 companies right now that we would begin to audit and fine tune. Some of these probably won't survive an audit. I question whether Arch Capital's 17.9 will survive an audit. And if that drops down, they may drop from the list. Just as one example, there's a number of companies on here I've never heard of, as well as Matt Spielman's Green Brick Partners just won't go away. It's had a great run. It's helped out our best small companies for a couple of years now, and it just is continues to hover there, and we hope for the best. But
When they heard the limit might be $2 billion, they divested the Denver operations so they could fit the ship.
excellent
Mark,
choice.
can I do 30 seconds on ACMR, please?
Absolutely. I was looking at
That's
that earlier.
down there. ACMR is a manufactures different things to help with people making computer chips. They don't make the chips themselves, but they do equipment to make them. They have a small office in California, and technically they're a United States company, but the exchange that lists ACMR recently indicated that they had to see some of the financial records for the company. And the company begged off, saying that those records were in their other office in Shanghai. And Shanghai locked the office and would not allow the American regulators to see any of the records. That's not a good sign for any company as far as being traded in the United States. So you need to watch that story very carefully. It's still in the process of back and forth between our own government and the ostensibly the ACMR office in Shanghai, but probably between the Chinese government and our government. And whether or not we ever get to see those records, whether or not those records actually exist in the form that they were filed, is a big question that is raised right now. And I would worry a lot about anything right now as far as numbers concerning ACMR.
Very interesting. We'll keep us advised if they find anything on pulled pork while they're in there.
Okay, they might find that company we lost. Okay,
it's hiding over there somewhere. One of the reasons I went with Dorchester was just to keep it high on my radar screen. It topped out here, and I think that the growth might be a little bit high here, the 16.7, but we shall see. The other thing that I found interesting was when converting to the 2025 sales projections over the projections for the year end 2024s, these are all positive now. It's been a while since we've seen that. And again, that's kind of one of the things we watch for industry or sector specific recessions or worse. And those numbers are more positive than we've seen in quite some time. So, and you can see how little coverage Value Line gives these companies. So very few of these are in the standard edition. All right, so with that, here's the current Buttonwood portfolio. We don't have any transactions planned. I did want to throw out a proposal, Ken, that we actually pick one of our weekly sessions every month and have that be the one where we go into, just like any club meeting, go in and address the portfolio.
I like the idea, Mark. Why don't we try to keep the club meeting to half an hour,
Okay, or less.
Or shorter, yeah.
And so we would be doing a challenge, and basically that will be after we receive the infusion of cash every month. So we will be basically attempting to strengthen this portfolio come second Tuesday of next month. I suspect that Lulu would be a pretty good target for funds right now, and Ann Manning is going to tell us about that tonight. So with that, here's the reminder that we do archive all of these sessions, including the bull sessions and some educational. Here's a special session we did for Arizona. The roundtables are on here also. Go to the YouTube, search on Manifest Investing, and you can find these. And here is a post, and this is a little bit of foreshadowing, perhaps. Matt had pointed out that his girlfriend has got a book out again, Annie Duke. And I plan to get a copy of it because I was very impressed with what Matt did on the behavioral investing side of things with that and Tillingham's book. So Matt, this one is Annie's book is out. The second book mentioned here, the third edition of Greenblatt's, I'm pretty sure is coming out in February.
Yeah, I get a used one. So they were on sale Sunday, but they're in the circulation. So if you're really cheap, you can put it on your wish list. It'll show up. Okay. And I've only started Annie Duke. I've actually gone back. Of course, we covered that a few weeks ago through Nassim Taleb's series. But think if you're investing, we talked about thinking in bets as making that buy decision or overall. What is, and so she talks about quick-to-itiveness, just like stick-to-itiveness, right? The idea of stopping when it's time to stop. When is it time to stop investing? So this is a book, in an investing terms, this is a book on selling, something everyone could learn more about.
That's what I'm
Matt,
curious about. Is this a when to sell theme in the future?
Could be. It could work its way into that sort of thing. It certainly is a lot of psychology in the selling decision too.
Matt or Mark, can either one of you read the red words above quit? Our audience is having a tough time reading from the slide. Do you know what those words are, Matt or Mark?
Yep, the power of knowing when to walk away.
Okay, great.
This is a future when to sell topic. I can feel it already.
Yep.
That's going to be some good, clean fun. And then I just wanted to point out, I have a stack of correspondence about the projected return on value that really has captured the curiosity of many people following the Chicago convention for the National Association. And again, we want to point out that that is actually a modified version of Greenblatt's magic formula, which is covered in this book. You can get the current one, or you can wait for that edition to come out in February. But I'm thinking that we could treat this Annie Duke book and a revisitation of the Greenblatt stuff and possibly cover both of those either in a segment or a series of segments in the future. So Ken, that's something to chew on for the future.
Well, I'm in favor right now, Mark. I like both topics. So,
all right. So with that, we'll just go ahead and shut down. I get a kick out of the. I remember when I only had 3 channels on my TV, and this happened at near midnight every night. And then we also want
I remember when I used to lay by the TV and be my father's remote. Right?
And they played the national anthem every night too, believe it or not.
Certainly did at 11:30 or 12 o'clock. Yep.
Good stuff. And then the picture on the right is just a reminder that our knights and damsels will be gathering tonight at 8 Eastern time to share 4 or 5 companies with you and walk through the analysis. So we look forward to that and invite you to join us. Again, it's free. And if you need information on it, drop either Ken or myself a note. So with that, anything else in the hopper?
Again, if you're looking for a way to register for the roundtable tonight, drop me an email or drop Mark an email. We can both send you links to get registered for tonight. And with that, I'm going to say good afternoon to everybody.
All right. Thanks, everybody. And thank you. An extra special thank you to Ty Hughes. Thank you, man.
Thanks, Ty.
You're welcome, Mark. Take care, guys.